Welcome, ladies and gentlemen, to a regular issue of the Grey Market Talk with Nic Themistocles, former market maker, wizard at Hogwarts, and a gentleman who knows how to run markets. And I owe him a lot of very good ideas on trades. Sometimes I lose money when I not do what he says. Occasionally I do what he says, and it seems to be working. You gave one great tip last week, when to short the S&P. I'm in it. Now I hope it's going to fall, Nic. Thank you for being here. I have to
tell you where you take your profits then, actually.
Lovely. And with Thorsten Wegener, I'm a former market maker. I still enjoy doing what I used to do. I'm less inclined to believe in that markets really have some divine know-how behind them. As a market maker, you believe in the bell curve, and putting those both ideas together seems to be working quite nicely for me. Nic, to get that out of the way, we discussed in the green room. You're going to ask me a question now.
Yeah, I actually felt like I needed to ask you, what are you doing at the end of July?
Oh, I'm glad you asked, Nic. I'm going to put it up here in the links. We are offering a bloody beginner seminar for options. 2 days in Seeheim, our seminar venue, where we will explain to everybody who always loved the idea of finding out more about options, being able to ask all the questions they never dared to ask. So it's not for advanced traders or rinky-dinky stuff. It's really, if you want to know how options work and you want to ask the questions, that's a 2-day opportunity for you to do this. And we start the evening before with drinkies to meet each other, not to spend too much time on introducing ourselves. So, hi, I'm Thorsten. I used to trade options. That will not be on the Saturday, Sunday venue, but on the Friday evening before. And if you like the idea, we cut the pricing down to nobody's going to make any money out of that. But I've got the questions. Can you explain options easy for real beginners? And that's what we're going to do. I don't know how many times we're going to do that, but if you have time and you're interested, join us end of July. So thank you for asking, Nic. Let's dive into the markets. We had an exciting week last week. We had PPI and CPI. What's your take on the numbers that came out?
We also had FOMC. And these chaps at the FOMC sounded a bit confused, I must say. Even though they got wind of the CPI, I think, in the morning, they still managed to tweak their, what they call summary of economic projections by 0.1 on where inflation was likely to be at the end of 24 or 25. And, you know, it's a bit cheeky, given that they missed the 9.1% sort of hike in inflation, that they're able to forecast a 0.1 adjustment in the CPI over the next 12 months. You know, I've got to say is, you know, really. And also they found out in the morning, before they published their summary of economic projections, that the inflation numbers were, quote unquote, better than expected. I mean, again, I think I've said it a few times here. We had 9.1% official inflation. And, you know, whether it's 3.3 or 3.4, it doesn't really, in my view, change the story. The only thing is that it follows the path that, you know, Tim explained when we discussed the CPI forecast, that there is a general trend of inflation falling. And we also discussed that when we talked about sort of money supply, what's trending, you know, what drives inflation. So the money supply has been coming down. It started to tick up recently, but the tick up recently is not really enough to drive inflation. So the general trend of falling inflation will continue. And so it follows our path. Yet the Fed felt that they were going to remove something in what's called the dot plot. In other words, their forecast of what the interest rate levels will be. And they reduced from 3 cuts, which they made estimates in March, to just 1 cut. And that's a bit of a surprise as well, because the markets immediately chose to ignore that and imply, you know, around about 2 cuts by the end of the year. And in fact, they increased the probability of 3 cuts by the, you know, Q1 next year. So really, I'd say probably what was going on was the Fed made a decision not to be seen to be, how should we say, influencing the election by jockeying around with the interest rates. And, I think that's probably more what guided their choice. I think what they were thinking before has not changed in my view. And so they're still on a downward path of rates, which, has been sort of confirmed numerous times. They certainly don't intend to raise rates. So it's just about how fast rates go down.
Yeah, it seemed to me also a bit confused, especially this. He wasn't too hawkish, actually, in his statement. I heard a lot of positive signs, actually, in the development of interest rates. And then you already mentioned the dot plot. Then they shifted it out a quarter into 25. It's the analogy would be there is the dumbest guy in the room, but everybody is nodding because he holds the gun, right?
Yeah, exactly. I mean, I think that's a nice way of putting it. But the people who are not in the room, the people who are in the market, basically said, if you look at the euro dollar futures, so these money market futures used to be called euro dollar, now a bit different, but the forecasting the rates, the 3-month rate over the next year, 2 years, 3 years, the path of interest rates, they immediately forecasted lower rates. After the guy said we're not going to cut rates, they immediately forecasted lower rates. So the December contract, which was trading around 95.04, which meant that the forecasted interest rate for 3 months was 4.96%. So from December for 3 months, well, that's now trading at 95.20. In other words, forecasting 4.8% interest rates, and that implies a higher probability of 3 rate cuts because we're in the 5.25 to 5.5. So you're going to take that down to, the 4.75 level. You're there or thereabouts with 3 cuts. And I would say the market is chose to ignore Powell. For whatever reason, maybe, as I say, it's political. Maybe they don't want to be seen to influence the election. You kind of get that. The Bank of England are kind of holding off for the July the 4th election in the UK as well. As if it's going to make a great deal of difference. They've turned the dial, from 0 to 5.5%. It has made zero difference to the economy. It hasn't slowed down anything. It's been slowing down for other reasons. But irrespective, it's what they did. That was the excitement of last week. But the most important thing from last week was interest rates showed, in the charts that we showed about 10-year yields before, that being the high point, and the money market rates, they're both falling. That's kind of, perhaps a little bit of switch from equities to bonds right now, or perhaps at least, another excuse to go and buy tech.
Yeah, I've got one interesting slide here. You see it now in front of you. Because if we're talking about this fantabulous first rate cut, everybody knows, okay, if there's a first rate cut, most likely there are more rate cuts to follow. And this Bloomberg slide, actually, for guys who are listening, it's just, I sum it up in one word. We know once the first interest rate cut happens, the world goes to shits in the equity markets, because then everybody is noticing. So shouldn't they be more afraid, actually, to open that reign of we're reducing interest rates after we've seen all-time high after all-time high, because then even the last guy in the Fed will notice the economy is in a bit of a trouble. Earnings will contract, multiples will contract, and we're pumping down interest rates, and that's when markets start falling. So they're caught now between a rock and a hard place. Or is my interpretation wrong, Nic?
Well, you are right to interpret the history, which basically confirms to you. So firstly, the notion of negative sloping yield curve spells doom and gloom, and what I think of that. I think that's kind of misinterpreted in the current environment. So then obviously the tendency is to say, well, actually, I know the other sort of golden rule is, and the golden rule basically says when we move from a disinversion to a steepness, i.e. when we cross the zero bound and the 2-year rates are the same as the 10-year rates, or the 3-month rates are the same as the 10-year rates, and we've got this flat yield curve and then it goes slightly positive. The rationale for that is, oh, the economy is doom and gloom. You see, I don't think so. I'm of the view that the rationale for cutting interest rates is because we have a hugely positive real interest rate. The real interest rate is a difference between sort of the yields in the inflation rate and the bond yields. So that if you imagine you've got bond yields at 1-year rates at, let's just say, 5%, and you've got inflation at 3%, well, that's a 2% real interest rate. And with such high debt levels, that's a bit high. You don't really need it. And, you know, in my view, as inflation starts to confirm is coming down, you need to reduce those interest rates. And it has, at this stage, nothing to do with the economy being weak. So inflation coming down is not sort of economy being weak. This is a monetary phenomenon, and therefore, I wouldn't read too much in steepness or rate cuts implies doom and gloom. Certainly, there are signs that the economy is slowing. Certainly, therefore, there's even more rationale to cut rates, but the economy is not really sort of showing, it's not flashing red right now. You know, these are sort of things that we've seen in the background, which can persist for a reasonable period of time before things really get bad. So I'm not the sort of the guy for the steep curve implies doom. It could do, but in this case, it's about inflation coming down.
That was also one of the statements. He was very cagey or mellow about it, but I had the indication that Powell was saying that the employment figures, the positive employment figures, are a little bit overstated. Did you hear that as well, or is that my?
You're right. I mean, that was also another market joke, I've got to say. I was preparing a presentation for a client, and the day that I wrote the presentation, the market, and I was saying, you know, buy bonds, right? And then the day that I was preparing this thing, the bond market fell out of bed because this huge, you know, supposedly huge employment number, 200,000+, expected 100,000+. Oh my God, you know, the economy is not a disaster, and you know, we're off to the races. So, you know, interest rates got to go up, and all of this palaver. And so I actually took, you know, screenshots of charts where we were to say, look, you know, this is I think it's going to reverse. So I mean, it was a bit of a bold statement because I had to forward this thing in advance, and 3 days later, of course, totally thing did reverse, and the market reacted so ridiculously bearish. But you know, that's part of the human kind of pattern, how people kind of evolve their views. We know, you know, they just follow the crowd. Everyone, he's selling stuff, I've got to sell, and so on. And that was nonsense. But Powell effectively said, you know, just be careful with this 200,000 number. We have had a bit of a history of revising this thing down in the past. And that's, you know, really a true thing, that you can't judge these employment numbers when they are released. You know, it might help the, you know, the brokers and the day traders to sort of make a buck here and there. But you've really got to, if you want the truth, you can only look back. So this is not a forward indicator anymore. You know, this is not, well, I mean, it's never been a forward indicator, but it's now such a reverse indicator, such a backward-looking indicator. You've got to wait another month to know what this month's sort of view on last month was, because you know it's going to be revised so much. So the data collection on this thing has turned, you know, awful, I must say, and untrustworthy, that, you know, people, I'm surprised we got a reaction in the first place, right?
I thought he finally got hold of Jim Bianco's emails, who's mocking them now for over 6 months, saying I can predict the numbers pinpoint accurately for 360 million people economy. And he always comes bang on with the same fake number that shows up. So
yeah, Indeed. I mean, as I say, it's an untrustworthy metric about the state of the economy. It's not really you know, telling you the state, because we've got to wait another month for a revision. And historically, these things have been revised down. So, you know, why get excited in the first place? I mean, it just sort of caused me a bit of stress to draw a chart, knowing that, oh God, you know, yeah, am I wrong on this thing? You know, I stick by my view. The market's wrong, and it was bloody wrong, right? Because 3 days later, the thing, as I say, rallied like crazy.
So we talked about the state of the economy. Let's talk about the state of the market. And I have one wonderful slide which sums it actually quite nicely up. You're seeing it in front of you, yeah?
I do indeed. I mean,
Two slides. One shows on the left Nvidia versus the whole of the German stock market. So you could actually short Nvidia and buy the whole of the German economy, which is listed at the stock market. And well, you would make a deal. And if somebody would offer this trade at these prices, I would actually do it, even though I'm not a big fan of what's happening in Germany right at the moment. Sure. But because the second slide I thought was the most inspiring. It's not the newest. We probably have all seen it, but it's Jensen Huang signing the bra of a young lady. And sorry, whenever I see something like that, when a business leader is such a pop star, that he does what the Beatles and the Rolling Stones and Queen did in the past. So the next indicator I'm waiting for is that Jensen Huang becomes Time Person of the Year by the end of the year. And then I would assume that the returns for Nvidia over the next 10 years will be negative in stock markets.
Okay, I don't know about that. All I can say, because this company seems still to be growing like like crazy. If you look at the forecasts, and whilst we were very suspect of the initial kind of sort of statements he made, they've proven themselves. The numbers do seem to, at least in the short term, stack up. So that view is the man of the year. I think is highly probable. I mean, obviously there's a lot of politics going on, and maybe politicians again come up there somewhere in this thing. But I do find that is a high probability, certainly on the short list. And the young lady realizes that, and she wants to get his signature. She's got his signature forever.
I'm fairly certain if she would sell that or offer that on eBay right now, she would make easily 20 grand.
Yeah, I mean that's
minimum.
That's a well. There's been so much news about this thing that I'm sure that there'll be a number of takers, literally. But we'll stay off that topic before we get into trouble.
No, I'm with you on Nvidia, yeah. But reflecting the past, it said in 2000, yeah, Amazon was a rising star. Okay, then we had the crash of the dot-com bubble, and Amazon is a fantastic company, yeah. But they had a couple of years of really slim pickings after that, and the question then will be, especially with artificial intelligence, they have these magnificent chips. All the other guys are working on chips as well. The margins are outrageous at the moment. Yes, simply by market dynamics. There will be other guys. There will be a second and a third wave coming in. They then will make money. The margins will shrink, and then the extreme high valuation will not make any sense anymore.
Yeah, I mean, that may well happen. But that's not how we kind of trade this thing. And we will probably see it in the price before we see it in another metric. But at the moment, the analysts still believe in the growth path. The important thing about that chart was actually the thing on the left. And the thing on the left with, the German stock market is worth 2.5 trillion. Nvidia is worth 3 trillion, I think was the numbers. And, that's a chart that should go to every German politician, frankly. They need to ask themselves why.
Well, it's got some truth in it, Nick, because there is Jensen Huang, who provides one of the most exciting products the world needs for the future. And the German economy is delivering pizzas and having these companies in their top stocks. Yeah? I was the other week in Frankfurt, and I was in my car in the evening, and you wouldn't believe how many Deliveroo drivers were driving around. So the whole of Frankfurt seems to be eating out or eating in. And these are the top-notch companies we have in the German DAX. Well, yeah, I'd rather...
I think Deliveroo and all of these guys are they're worthy companies, but the problem is that, if you're not, as an entrepreneur, investing in something like, Nvidia did, or, Microsoft or Apple or whatever, there has to be an underlying reason for it. Why is it that Germany stopped delivering top companies. And I think, as I say, that's a question for politicians with senior management. I've got my own views on this thing, for another day. But I think,
Yeah, let's not get political. Otherwise, it's going to be a 5-hour podcast.
Yeah, I agree. And I think that, but this is something that they should be discussing amongst themselves, because if they do want to show a perspective to, the generations to come, then it needs investment. And you have to ask yourself why there's no investment and all of this stuff. And it's a really big discussion that they should be having. And it's great to see somebody plastering that chart and putting it in a newspaper or magazine or whatever, and hopefully it lands in a German newspaper or magazine or whatever, and starts a conversation, because I think that can only be good for Germany in the long run.
So we are now with Nvidia, fantastic segue, and the market reflects that. Obviously, Nvidia being 6% in the S&P, and I found this great chart. It's the average cumulative S&P 500 total return from the 1st of January 88 to December 31st in 23, and it has 2 bars on it. The gray bar says invest on any day, and the green bar says only invest when there's a new high. And it shows the performance over 3, 6 months, 1 year, 2 year, 3 years. And riddle me that, Nic. If you would have bought every time you made a new high, you would have outperformed the simple buy it any day strategy by quite a bit.
Okay, that looks obviously on the face of it a wonderful thing, but like any analysis, you got to sort of dig a little bit deeper, and that, unfortunately, the chart doesn't do that. But for example, is the Sharpe ratio. So in other words, are you exposed to more risk if you do that in your portfolio? Do you get more swings in your portfolio, swings that perhaps you can't take? And that's just something that is missing from the chart. But it's kind of a sort of an interesting thing. But you say here, invest at a new high. Well, if there's a new high which starts in January, and then you invest in January, and then comes January the 2nd, or let's say Jan 1, and then Jan 2, you got another new high. Well, you've just invested. Have you invested all of it? Have you invested part of it? So, okay, how much do you keep investing? So I really wonder how these statistics have been actually collated. Fascinating as it is, I'd say more homework is needed to be had here, especially about the volatility. I really don't know. I mean, maybe it's right, maybe it's wrong.
It's a very good point. I'm going to propose that to David. We run that in our own sweatshop, especially in incorporating what you said, the Sharpe ratio. Yeah, how was the Sharpe ratio at these levels? And if we build true averages, especially the 1st of January, 2nd, 3rd, new highs, to compound how that comes out. But I thought it was a very seductive chart for the retail customer, because right when I started, which feels like an eternity ago now, it was always this, even the street by then had noticed, we make new all-time highs in a stock, in an index, you name it, you buy. The reasons will be delivered afterwards.
And the other thing, of course, you might want to see if in your tests, I don't want to give David more work, but what about if you sell on a new low? I mean, I bet you don't make money, because obviously the markets in general have been going up. So, how does that work? Frankly,
well, it's like the German Sendung mit der Maus. We would have ample opportunity to test all these things, but then at the end of the day, it's just backwards looking statistics. Yeah,
in a way, yeah, absolutely. But it's good that you've got a history for the 35 years or whatever it is on the S&P. But for those people who haven't invested, they're still kicking themselves, because they've missed a lot. I mean, clearly equity markets have historically been going up, and the people I talk to really don't care if they make 40% or 48%. I think they're just happy they made 40%. So some of these things are nice. But anyway, fascinating story. Unfortunately, it's given David a bit more work.
That's fine. We thrive on that. If it gives us a leg up somewhere, it's always fine. So it brings me back to cycle time. Yeah. You're the guy with the most experience, the longest experience. Where are we at the moment in the stock market cycle?
Yeah, so I've for different reasons, I've kind of always said you're kind of okay up to 2025, 2026. We know that certain stocks are particularly at the upper end of their range. So if you look at historical PEs, they are sort of not at all-time highs, but they are at highs. So we know that we are above the center line, right? So we know we are in this kind of getting up towards this expensive zone. So, are we at that yellow circle, on the very first yellow circle? I'd say, yeah, probably. It sounds about right. Probably closer to the red dot than sort of in the middle, but still we're not reached that red dot point yet. So, and we're not in any way sort of head for the exit. So the market is still positive. It's still got momentum. There's still money coming into this thing. Are there more value areas to be had? Yeah, but they have not rewarded you in the past. So it's only been a few stocks that have taken you up. Breadth, we know, is not very strong. So every time the IWM, which is small caps, time that rallies, it kind of keeps stalling. It does have its moments, but it keeps stalling. So there's still this unwillingness to buy anything other than the large cap stocks.
It's actually one interesting observation I made is when Apple had this big breakout last week, which you kind of hinted towards in our last virtual trading floor, just to give you the credit where credit is due. I would have expected, if you would just see the breakout of the big mega cap Apple, you would assume that high tech is on fire in this week. Guess what the correlation between the high techy tech techs was? At zero for the week. Nvidia was on the other side. Nothing actually really happened, and you would assume, what's going on here? Wow, the market must be burning up, and that was actually my segue, because this morning when I went through my slides, I thought, let's go on the CNN Fear and Greed Index with the market at new all-time highs, with Apple pushing upwards, Oracle showing fantastic numbers, jumping out of the hoop, Nvidia now having the stock split, everybody still, there must be Roaring Kitty. God, I almost forgot the most important news. Roaring Kitty in the market, giving live interviews, and I don't know, he made 300 million, lost 200 millions in the course of, 12 minutes or something like that. I would have expected the Fear and Greed Index on being totally in greed or extreme greed mode. And then I saw this, Nick. That surprised me.
Yeah.
Are we climbing the proverbial wall of fear?
Well, every number has a component. So, let's look at the components.
Yeah, let's get in there. See, every time when I want to do it quick, I'm going to not find my share button. Now we've got it here, there. You see the website?
Yes.
Yeah, let's go into the components. So overall, we're on fear. We've been on neutral a week ago. A month ago, we were on neutral. And a year ago, we had extreme greed at 79. So market momentum, as expected, extreme greed.
Yeah. So a year ago was May of 23. So we had extreme greed. Does that kind of fit, where the market was, really?
Look here.
And that was greed, was it?
That was greed, extreme greed. So the extreme greedy boys got it spot on. The S&P was trading at 5,120, give or take.
Yeah, it's good to be
and
greedy.
the greedy crowd said, yeah, let's do that.
Ship it in.
Yeah. So extreme greed a year ago was right. Now we are far further away from the averages, and that is what the momentum actually tells us. But we both know momentum can run on and on and on as long as liquidity is in the market. So extreme greed here as expected. Stock price strength. What does that tell us? If you big stocks can skew returns for the market, it's important to also know how many stocks are doing well versus those that are struggling. This shows the number of stocks on the New York Stock Exchange at 52 weeks highs compared to those at 52 weeks lows. When there are many more highs than lows, that's a bullish sign and signals greed. So yeah.
It's like the advanced decline line. I think Tom McClellan, whose parents invented the McClellan oscillator, and he has a very, very good Twitter sort of thing. And I think a few weeks ago he wrote about the weakness in the advanced decline line, and he said it's usually been a kind of a prophet of doom warning, if I remember the story right. It was a few weeks ago, but he said, it is a status of the market or a condition of the market. It's not a signal. So, this idea of the stock market strength being sort of concerning, you can see has been sort of in play for a few weeks, but it's not yet created a signal. It's not created any signal. It just says, that's the status situation of the market. But Tom McClellan, is worth a good read.
That's actually the indicator from Nick, where I want to see extreme greed. I want to see a lot of stocks in the stock market making new highs, that I have market breadth in here. Calling that extreme fear is in my twisted mind the complete opposite. If everybody is just buying 3 stocks,
yes,
and the
absolutely,
not doing well,
it is as Tom says, it's a market condition, but it's not a signal yet to sell.
Good. Let's go to the next one. Stock price breadth. The market is made up of thousands of stocks, and I'm just reading here CNN. And on any given day, investors are actively buying and selling them. No shit, Sherlock. This measure looks at the amount of volume of shares on the New York Stock Exchange that are being compared to the number of shares that are falling. A low or even negative number is a bearish signal, and fear and greed index use decreasing trading volume as a signal for fear. It's also, I would go concurrent with that. If we actually see really decreasing trading volumes, I looked at the flow of funds in the S&P ETFs last week. They were far above their long-term averages on a weekly basis. So there is money pumping into the market. That's what we're seeing at the moment.
What I tend to do on stuff like this is I always overlay an S&P chart. So I sort of, as an indicator, when how good are these signals, and when do they function, when do they not? What also needs to be in play when there is do I need stock breadth plus put call spread options to be in play before I can say that's a signal? So if you can see that sort of from the beginning of January, stock breadth has been falling. I mean, we were at 2,000 then. We're now at 1,000. So if you kind of used it as a signal already sort of in January when you started to see this thing come down, you'd have missed this 20%, whatever it is, rally in some of these stocks. So, we have to sort of distinguish between, as Tom McClellan says, quite often, a condition of the market rather than a signal.
Then where I came from, that's why my original assumption was I should actually see greed, the put and call options. Everybody is punting the upside for a quick buck in there. It seems to be working at the moment. So the retail crowd and, well, even the pro crowd is positioning themselves to buy some upside, to be in the market if things break away to the top. What is going to be expected? What I'm surprised about is the extreme docile volatility we see in the overall market. That is actually a sign for me where we have complete complacency. It can only go up. You barely find in the option markets, or the guys who are punting with options, let's put it in that perspective, a discerning opinion. Everybody's saying, we're easily seeing new highs, 5.5, 5.6 in the S&P. That could happen very fast. Your magic charts showed us in 2 counts. You demonstrated to us in a private session. There was a level at 5,440. Am I remember that correctly? Which was at least a level for a short-term correction. I actually took your advice and bought puts at exactly this level.
Very good. It was fascinating, isn't it? How we were 100 points lower, and it was a difficult call, I must say, at the time. But the power of Fibonacci, it's the best indicator in the market in my view. When Elliott Wave and Fibonacci, and they're all together, I see them. But I mean, it is much more helpful than many of these numbers that you see sort of being put out on YouTube. This is this level here, and look at that over there. So yeah, I mean, we have to look at what happens from now on, but that was a good call, I must say.
Market volatility, they rate it as neutral. I call it extremely low at the moment. Yeah, if we're trading in a VIX at 12, yeah, we might go to a 10, but hey, that makes cheap hedging available. Cheap means I'm not buying it after something happened. I can get it here at levels. Yes, I will have to pay a little bit of carry, but for every sensible fund manager, it's clearly the right time to work on that good old Sharpe ratios and put a little bit of protection, downside protection in, especially if you get it offered for these terms. Yeah, the volatility is extremely low. So it begs to say, yeah, take the risk of paying some carry, but sleep well in the night. And then a question here, the safe haven demand, which I found very interesting. We can put that together with the junk bond demand. We were looking at the HYG, and you were looking at the junk bond index in the green room. They're also at really still elevated levels. What are we making out of this? Because I'm actually stopping this and put a nice slide in, which goes beautifully together with this. That was, I'm all over the place a little bit today, but I thought I'm not keeping the order we have here. Good old France after the elections. What does this chart show us? First of all, it's a wiggly line which goes sideways, and it has a medium about 26 basis points. And it says CDS price on it, and it says cost of insuring against France default. And then we see a jump from 24 to 38 or 39 basis points. Nick, what's a CDS?
So CDS is an insurance premium, basically. So you want to, CDS stands for credit default swap. And so a buyer of a credit default swap, if you like, pays premium like he would do to his insurance broker for an event. And, you know, the CDS on France is in the event that France goes bankrupt, then you get paid off, right? So, but obviously, like any insurance policy, you have to pay a premium. So the premium is the, you know, the spread that you are paying. So you used to buy insurance premium paying 24 basis points, so 0.25% on this insurance policy, and now you have to pay 38%. So therefore, it's rallied by, you know, the premium is rallied by 50%, but it's still relatively low. But
we discussed that again in the virtual trading floor, yeah. And I said, well, that's what is going to happen. The one thing which is actually I find totally surprising, France can only go bust if Germany goes bust, right? And Germany needs French energy. Therefore, Germany will always have to give money to France in a worst case scenario. Otherwise, we sit in the dark over here. They have the lovely nuclear power plants, which actually make our industrial production still possible. One would have assumed then that also German credit spreads would suffer. The opposite was true. German bonds were the safe haven after this election. Can you explain that to me?
I can't.
Yeah.
So the, you know, when people do have these trades on, they're not playing for default. They are just reflecting that, you know, there's been a catalyst. So let's go back. The French have an incredible amount of debt. So sovereign, private, corporate, you name it. The French in Europe are, you know, up there, right? So if you're looking for trying to find a cheap protection, you probably would have been buying French CDS over the years, but you've been paying for this thing. There was no fire, there was no catalyst, and now we have a political catalyst. And what is that political catalyst sort of concerning? Is it concerning a Frexit, perhaps? You know, the French want to leave the EU. Don't know, but really is early days. And I think this is trading around lots of noise for now. And, you know, kind of a warning for everybody that investors are somewhat concerned. They should have been concerned about French debt a long time ago. But, you know, like everyone, you sort of do your homework. You say, oh, the French got a lot of debt. should we be buying this stuff? Oh, no. And then a few weeks later, nothing happens. It's like, let's go and buy some French debt. And they do go and buy some French debt, and they just stick with it. And then they carry on buying it. They forget all the analysis that they've done. And then suddenly there's a catalyst and it says, oh, there's a reminder that French debt is a bit, expensive, given that, they have a lot of it. It's like the situation we talk about with some of these stocks. When we say they're expensive, we still buy them. They're in the portfolio. And then suddenly something happens, catalyst, liquidity goes down, and then these things sort of come back to reality. So you're playing a dangerous game when you're buying stuff which relies on status quo, and status quo is something that doesn't persist. Frankly, it's sort of every now and then you do get the shocker, and I'm surprised, frankly, because the polls. I don't mean the Polish. I mean the polls for the election. Before the election, was quite clear that Macron was losing favor. Months ago, you could have sort of forecast this. So, in retrospect, it was a no-brainer trade. Where it goes from here, I don't know. But, this is just market noise.
You mentioned the shockers. We have actually two coming up. We have the French election coming up, and we have the British election coming up. And one of the interesting things is Reform UK is now the official opposition. They rate higher in the polls than the Conservatives, the Tories, actually do. So let me paint you a picture. For whatever reason, Reform Party is this time getting into parliament, even with your first past the post system. In France, Le Pen is having a huge win. Would that then mean that Nigel Farage, as the eventually new prime minister, would lobby to rejoin the European Union because they are now far right, as we see all over the place? Or what's going there? The European Union is toast if this trend continues, right?
I don't think it's toast. I think let's just sort of, I go back to the chart that you showed 2 minutes ago with Nvidia and German market cap.
Yep.
And I'd say, is this current situation brilliant? And the answer to that is clearly not, based on the chart that you showed quite independently. The German economy, this is a fairly new country, but this sort of whole industrial base is unable to capture the imagination of the world and find the leadership in the corporate world. Perhaps change is good sometimes. So we'll see what that means. And right doesn't necessarily mean extremist or sort of racist or all of this stuff. Right just means a different type of policy, and perhaps a different type of policy is what's needed. So maybe that's a good thing for Europe.
Well, right, just nowadays a new definition simply means everything hardcore communists don't like is Nazi, right?
Well, I mean, let's look at Giorgia Meloni. So if I remember rightly, the president of the EU, you know who she is, said, well, if she gets in power, we know how to deal with that. I mean, obviously, it's not a democratic thing that she said there, but the good lady Giorgia Meloni got into power, and I don't see any sort of fascist policies. Sensible, sort of level-headed thinking, and been doing a good job. So perhaps people say, well, if the right are not sort of extremists, but they have sort of sensible policies, then actually perhaps that's what we need in Europe, and maybe that's a good thing. So I think everyone's in a bit of a tiz, in the CDS market. Probably somebody in senior management came up and said, well, we have to sort of protect ourselves. We will not buy French paper anymore, let's say. Those decisions sometimes do take place, and maybe that's where you get the noise from. But anyway,
can you imagine the biggest elephant in the room I haven't even mentioned? United States election. Donald Trump wins. We have a complete mess with Ukraine here in Europe. The Germans and the Frenchies now lobbying for, let them use all our weaponry to fire guns into Russia, and let's set the French army in. Then Trump wins and says, hey, you made the mess yourself. You have at it. Be responsible for your own defense. Then I want to see the credit spreads in Europe.
Well, I mean, again, some change is good, and let's see what does come out of all of these things. But you're right. In the end, is that the politics in the UK, the politics in France, the politics in Germany, the politics in America, all very important kind of events, yeah, and they will for sure shape the world for the next few years. And when I look back over the last 2 years, I think whoever shaped the world for the last 2 years or 3 years or 4 years, let's go back to 2020. So the shaping of the world subsequently to Jan 1, 2020 to today probably wasn't what you might call ideal, and perhaps the shape of the world for the next few years, maybe it starts with a noise, but it ends with calm.
Excellent. So while doing this, let me just show everybody what we are definitely not going to do today, because we ran out of time. Elliott Wave, 2 beautiful pictures, Beauty in Nature, Don Fibonacci. You can find it everywhere. Just as a little teaser for all our viewers, stay tuned. Listen into the next Gray Market Talk, which most likely will be next Sunday. We had so much content over the last weeks that we got our schedule a little bit out of order. But obviously, I'm getting more and more around to actually want to know what Fibonacci and cycle theory tells us about these markets. I always get interested, Nic, when I start making money on these predictions, even if I don't understand them. So,
frightening. I feel responsible, even though this is purely educational and entertainment, Thorsten, as you've always alluded to. Yeah,
absolutely. So if you like this video, I put at the back right now again the CPI PPI discussion Nic, Tim, and I had, worthwhile watch, especially now that you can see what the predictions were and how the numbers actually came in. That there's merit to it. So take the time, have a look at it. And otherwise, I'm saying thank you very much, Nic. That was a jolly, as always. Yep. Any last words from your side?
No, I'm going to go and play golf.
Lovely. Thank you very much for viewing. Bye-bye.
Take care.